Alright, hello everyone and welcome back to another video. I have not made a video in about a month, so please do consider subscribing. Subscribe and it makes me, want to make videos more. And I did not mean to, wait a whole month to make a video, but, in the meantime, since you're watching this one, please do subscribe, and I do see the amount of subscribers that I gain, even if I'm not making videos, so please do consider subscribing. Now, let's get right into it. Here is a fun one. I don't know why I haven't analyzed them before, but here is GameStop. Ticker symbol, you all know it, GME. It's at the top of the Wall Street bets. It was an empty vessel to kind of, use as far as the short sellers and try to target the rich hedge funds that owned it by trying, not owned it, but shorted it, making them have to buy it. So that way this thing went way up when they got margin called. And yeah, it has just taken off like a rocket, and it's been up and down, up and down. And a lot of little guys, people like me and you, they made a lot of money off of this, which is great to see. Forget about the hedge funds that, try to make billions in profit every year. Boo hoo. Go away. Let the little guy make some money every once in a while. So, with that being said, the typical analyst, there are 6 analyst ratings, and it's a moderate sell. And they have a price target of about $70, but as of June 11th, 2021, GameStop is at $233. So that's a 70% downside. That's pretty big. And the average high, it looks like, is about 175. That's what one analyst calls for it. So even then, you're losing, quite a bit of money on this, a little bit over like 50 bucks from where it is right now. So let's look at the stock analysis, and it's a 4. It's not very good. 4 is not very good. That's not really what you want to see, but again, this is a meme stock, so anything goes. The fundamentals are out the window. Speaking of the fundamentals, let's get into it. So in their fiscal year that ended on January 30th, 2021, GameStop made an annual revenue of about $5 billion. That is the lowest it's been in quite a while. Like you can see that it went down, it went up, it went down, it went down, and it really went down. GameStop stores were mostly closed throughout the pandemic. And people just really turned to online gaming, which they don't really sell a lot of games online, like as much as they do, I think, rely on mostly their in-store revenues. They're a brick and mortar retailer, and Ryan Cohen is trying to turn that around, and we'll see what he does with that. We'll see what ideas he comes up with. But GameStop definitely struggled revenue-wise. They've seen a decline in revenue, and in turn, their lowest profit in quite a while, their lowest gross profit. Now, if we look at their net income, they have been losing money for the last, 3 years or so, which this is interesting. Obviously, they made lower revenues. They had lower revenues compared to even, 2 years ago in 2019. They're down almost $3 billion, but they don't have as big of a loss. And that's pretty interesting. I think that's pretty interesting. So they were able to cut their expenses as well, whether it's because they laid off a bunch of employees, kind of left, and they don't really have a people expense, because remember, people expense is usually always the highest that a company has to bear, and that went down. So this, in turn, was not as bad as it could have been for sure, to only lose about $270 million for the year. That's not incredibly bad. Could have been a lot worse. Now let's look at the balance sheet. So with the balance sheet, GameStop still does have cash on their balance sheet. As of 2021, they had about 508 billion, million, not billion, 508 million, and it's higher than what it was in 2020. So that's pretty good. They had a significant cash pile that they had to burn through. It looks like, 1.1 billion that they had to burn through in 2020. That they had at least had in 2019, so they didn't have to go bankrupt. They could definitely supply themselves and hold themselves up. Their total current assets are about 1.5 billion, and their total current liabilities is about 1.3 billion. That means that they are going to be solvent, and they are, they're not going to go through insolvency and bankruptcy and all that, because they actually do have enough to meet their current demands. With their current assets, they have enough to meet their current demands. So they shouldn't have a massive financial problem. They very well could, but they shouldn't. Even if we see from like 2020, they had 1.6 billion in current assets and about 1.2 billion in current liabilities. Obviously, like I said, they burned through a lot of cash, so that went down, and it's a very slim difference now. From where they had a lower total amount of current assets versus the year before, where they actually had, about a $400 million, let's just say, gap, delta between between how much they could lose, and it got slimmer. It definitely got slimmer in 2021, but it's good to see because they have that. They had that ability. Total long-term debt. This is actually great. This is a great thing to see. As of, like I said, their fiscal year ended on January 30th, 2021. They actually have been decreasing their long-term debt, and that's what you would want to see. And actually, Jim Cramer made a comment about how, why doesn't GameStop with all their cash just eliminate their long-term debt? That would eliminate payments, and it would eliminate sharks, people coming after them. So that was a really good comment by him, and that happened right around the thick of the whole meme stock thing, which is like January 2021. December 2020, January 2021, and it's crazy to see this, that they have the lowest long-term debt, even though, like I said, they've had decreasing revenues, and they've got a very slim working capital compared to the year before. So anyway, that's a really good thing to see. Total liabilities is about 2 billion, and total assets is about 2.4 billion. Again, they're barely above where what's comfortable. The year before, they're about 600 million gap, and now it's about 400 million. So it's slimming down. They need to keep an eye on that, but so far they can definitely make it through anything that comes their way as far as financial apocalypse goes, because total current assets is more than their total current liabilities, so they should be able to meet their demands. Anyway, let's move on to the cash flow statement. So in the cash flow statement, we start out with a negative net income, obviously, and then if we look down, this is something that's pretty crazy. This is kind of cool. They issued more long-term debt, but then they also repaid a lot of long-term debt in their fiscal year 2021. Now we're in their fiscal year 2022, but in their fiscal year 2021, they paid down about 255 million in long-term debt. That's really smart. They have a smart CFO that continues to pay down long-term debt, and we saw that they have their lowest long-term debt in like 5 or 6 years. So that's really good. And then we can see right here, this is for their full year. They had bought back about almost 200 million in shares in 2020. But in 2021, they did not make any share repurchases. That is smart. This is a dumb thing, though. This is a really dumb part on their CFO. And again, financial pundits like Jim Cramer, they make comments, why didn't you issue more shares like AMC is? You're taking advantage of all these people that are, in and flooding your market with such huge volumes every single day. The retail traders are just kind of taking over. Why wouldn't you take advantage of that? They aren't going to go anywhere. It's the stupid hedge funds that were shorted against you that really didn't care about you and weren't really in it for the long term. But you have long-term thinking investors, most likely, with these retail traders. So why didn't you issue more? But if we actually look at quarterly versus annual, this is kind of cool. And I just want to get a little side topic. So their GameStop's fiscal year 2022 quarter one ended on May 1st. And in that time, they actually did issue right here about $500 million, $550 million in in equity. So they've issued new shares worth about that. So they've raised that amount of money, and that will in turn, I don't have it right here because it's on the balance sheet page, but that will in turn help their cash pile because they took advantage of that compared to 3.1 million, 551 million. That's way better. Why not? Why not take advantage of that? Ryan Cohen, let's see what he does. Anyway, okay, let's move on to a portfolio of GameStop. So if you had invested $10,000 in GameStop in the year that you could, which was January 2003 to May 2021, you would have approximately 647,000 or a 25% compound annual growth rate. And if we look at the annual returns, we can see that, GameStop very early on, starting in 2003, did very well. Look at this. This is very good returns all the way through 2007 and obviously 2008 took a huge dive and your $126,000 investment turned into 44,000. Ouch, that burns, that sucks, that hurts. Ouch, ouch, ouch. That I feel that stinks. And they just kind of meandered through all the way to 2013. And then they just kind of lost and fell off a cliff up until last year, like towards the end of the year. It was like November, December 2020. They kind of turned into the meme stock and the meme stock mania, and they were an empty vessel because they didn't really have much in sales and much in revenues. That they kind of turned into this meme stock. And now this year it's up 1,000%. So that definitely helps because as you can see, by the end of 2020, you had a $57,000 investment, and then by May of 2021, your $57,000 was worth 674. So that's just interesting. They've had a lot of downturn in the past few years, and that hasn't really made for the best investment up until recently when you get 1,000% return. Anyway, hope you guys like this video and hope to see you soon.